The decline of the Malaysian ringgit after hitting a 26-year low is the only way up. Earlier this year, in February 2024, the Malaysian ringgit dropped to its 26-year low against the US dollars, the greenback, where 1 US dollars equals to 4.8 ringgit, and against the Sing dollars, it dropped to 1 Sing dollars against 3.57 ringgit. All household income groups from the T20 to M40 and B40 are hard hit by the depreciating ringgit, especially when Malaysia imports about 60% of their food from other countries. Moving across the border to Singapore, the Singapore dollar is one of Asia's top performing currency for the last 5 years, and against the American greenback, it has maintained its pre-pandemic level of 1 US dollars to 1.34 Sing dollars, hitting a low of around 1.3 to a high of 1.45 during the fluctuation years of interest rate increase. Hi everyone, I'm John, one half of the Corporate Breakout Couple. Well, today's video is not specifically about Malaysian ringgit or Singapore dollars. More importantly, it's about currency strength, foreign exchange, and how they affect you as an individual. You see, personally, I'm a forex trader and I'm also an investor of different asset classes. And through my experience of trading forex, I realized that there are a lot of factors, especially in the world of forex, that actually affects you as an individual in two main areas. The first one is your day-to-day costs, your living expenses, and the second one is your financial future. Understanding these dynamics that I'm about to share will give you an added advantage in plotting your financial future. The relationship between your country's currency against the world reserve currency, the US greenback, the interest rate set by your country's central bank against US Federal Reserve's central bank, which is the Fed fund rates, and also the supply and demand of the currency in your country that will determine the decline or the increase of the currency strength. At the end of the video, I will share with you 3 ways how you can limit your risk as an individual to hedge against currency fluctuations in your country. Before I continue, I will appreciate it if you hit the like button and subscribe to join our YouTube family so that we can create more videos like this for you. How does debt and interest rates affect the currency strength of your country? In 2007 to 2008, where US suffered the subprime crisis due to elevated housing prices and over-leveraging, the great financial crisis happened across the world. Why was this housing problem caused by over-borrowing of the American people passed on to the world? Due to the bursting of the housing bubble during that period, it causes a severe decline, a collapse of housing prices, which then led to a lot of mortgage defaults, which means a lot of mortgage-backed securities that are held by financial institutions. The value also declined severely. And a number of these financial institutions which didn't have healthy balance sheets, such as Bear Stearns and Lehman Brothers, collapsed, and even the big banks that are backed by the US government like Citibank were also on the verge of collapse. So in order to bail out all these financial institutions, in came this brilliant idea by the Federal Reserve Chairman at that point of time, Ben Bernanke, introducing quantitative easing. The simple explanation of QE is printing more money, and that introduces a lot more debt into the US economy, as well as increasing the supply of money into the markets. Needless to say, since the QE measures introduced by the US Central Bank, the US debt has been on an upward trajectory. And what does this mean for the other nations? Well, because US is currently the #1 economy in the world, and the greenback is the world's reserve currency. That means in order not to rock the boat, other trading nations will need to maintain and peg the similar rates with US dollars, which means if US prints money, the rest of the world follows as well. As a result, debt is not just introduced in US, but in other parts of the world as well. Now let's switch to interest rates. The interest rates that's determined by the central banks in each country affects the borrowing costs and also in turn affects the supply of money in the market. When interest rates are low, the cost of borrowing is low, that's when companies and businesses will borrow more money to stimulate their businesses, which will then drive up the economy and also causes inflation. On the other hand, when interest rates are high, the cost of borrowing is high, therefore companies and businesses are less inclined to borrow money, and therefore there's less spending in the economy, which causes the rate of inflation to decrease as well. Now, what's the dynamics between the US interest rates against your country's interest rates? I have two countries as an example for you. Let's look at US against Malaysia and US against Japan. The current US federal fund rate sits at 5.25 to 5.5%, while Bank Negara of Malaysia holds at around 3%, and for the Bank of Japan, it holds at 0 to 0.1%. These interest rates that I've just mentioned, that are set by the central banks of the world, will determine the base lending rate, for example, for the mortgage loans, for the fixed deposit rates that's in that country. Back to the Malaysia and Japan example against the US interest rates, because when US started increasing the interest rates to curb inflation since 2022, Malaysia and Japan has not increase their interest rates as much. In Japan's case, they have been staying in a negative interest rate environment for the longest time to stimulate the economy. So what happens is the currency of both countries depreciates against the US greenback because the interest rates are not keeping up at the same pace. This is very evident from the Forex chart that you're looking at, the US dollars against yen, where in 2022, US to yen sits at 110, and now in 2024, it sits at 1 US dollars to 155 yen. In conclusion, in terms of debt and interest rates, how US Central Bank decides to roll out their quantitative easing policies as well as their interest rates will affect the rest of the world in terms of currency strength. Another huge factor that determines the currency strength of your country is the supply and demand of that currency in the world. For example, the US dollar currently holds 58% of foreign reserve holdings worldwide, followed by euros, which is a distant second at 21%. When the demand of the currency, in this case the leading one is US dollars, is higher, it means that the US dollars will be able to hold its value well as appreciate if the demand increases. Another key factor that determines the currency strength of a country is the import and export factor. An export-centric country such as Germany, which exports a lot of cars, Japan, which exports a lot of cars, electronics, China, a huge exporter of manufacturing products, oil-centric countries such as Malaysia, Canada, these countries, they want to keep their currency equal or lower, especially during times of inflation against other currencies, so that their prices can remain competitive and they can sell more products. Case in point, you may have heard of articles in the last decade or so saying that China artificially devalues its renminbi, especially against US dollars, so that they can remain highly competitive in the global marketplace. Earlier on, I mentioned that it's essential for you as an individual to understand the impact of the currency strength in your country to you as an individual in two ways: the cost of living as well as your financial future. In terms of your living expenses, it might go up, especially if your country's currency depreciates against the country, let's say US for example, where you import the goods and services from. You'll be paying more for imported brands. Another way it will impact you is travel, especially when you're traveling to another country where your country's currency is weaker against. In terms of your financial future, if the currency of your country gets weaker and weaker against other currencies of the world, example, if it doesn't perform well, that means the amount of money that you save up, whether it's for your retirement or any big ticket item, might erode in value. Here are 3 ways you can hedge against currency risk. A disclaimer here, whatever I'm sharing is not financial advice and is purely for educational purposes only. The first way is to move a weaker currency into a stronger currency that you can foresee has more stability for the long term. For example, if you are a Malaysian and you know that the Singapore dollars has been steadily appreciating against the Malaysian ringgit for the last 20 years, you might want to consider moving a chunk of your money into Singapore dollars for the long term to hedge against the depreciating risk. The second way you can hedge your currency risk is to buy assets that outperforms inflation. For example, a hard asset like real estate, which can outperform inflation and hold out on its own to make sure that it increases faster than the rate of inflation in terms of the prices. Another possible asset is precious metals, which can perform well against inflation and also has an inverse relationship with fiat currencies such as the US dollars, which means when there's more money printing and more debt in the world, the value of gold and silver can go up tremendously. The third way you can hedge your currency risk is to diversify. Usually, when you hear the word diversify, it typically refers to diversifying in terms of investing. Well, I'm not just referring to that. I'm also referring to diversifying your skill sets in terms of other kinds of passive or active income skills. Diversifying your skill sets not only allow you to bring in multiple income sources from different ways, it is also a hedge against holding one source of income, which is your job. In case you're unaware, my wife Fran and I conduct free masterclasses a few times a month. Do join us where we talk about topics on investing, passive ways of creating income sources, personal finance, financial literacy, early retirement, cost of living, and many more topics that's entirely related to your financial future. So do register with us in the mailing list below where we'll share details of our free masterclasses. I hope today's video has illustrated how important it is for you as an individual to understand the dynamics of your country's currency strength against the economies of the world. With that, thank you so much for watching this video. Do hit the like button and subscribe to join our YouTube family. See you soon!